Good morning.
Yeah.
We both have to on the power, right? And we're trying to make the on the power, but we have to on the power.
Yes, we can hear you.
Hello.
Yes, I can
We
hear
can
you.
hear you. We
Okay.
can hear you
So
now.
I think, yeah, what I'm going to do is, uh, okay, can you hear me now?
Yes.
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 Okay, okay, good, good, good. Okay. Okay, so I'm going to record these things. So I think some of you knows how the option works, but for the people who they don't have any idea how the option works, um, uh, I just want to give them little insight about um, the option, what option we are talking about, what method we are talking about. So um, I usually start with this one example, and it's pretty simple that let's say if you want to sell your house and your house is $500,000 worth, and your friend knows that you are trying to sell your house. So he comes to you and he says, I'm going to pay you $500,000. I'm interested in buying your house. But there is one thing that I cannot make purchase. I have to wait until 3 months to arrange the finance. So for those 3 months, you may have a couple of questions for him. That the first thing, that what happen if after 3 months, if you say no and you lose the prospective buyers who came who comes during those 3 months. Second thing, that you get probably the better price, or the price drop down to 480,000, and then your friend says that I'm only going to pay you 480,000. In that case scenario also, what you going to do? So your friend says, okay, let's make a contract. In this contract, what I'm going to do is I will purchase your price for $500,000 before the midnight of 3 months expiration date. For holding this, for holding your house for 3 months, for me, I'm going to pay you $10,000 premium. So that premium is, it's yours, basically, if I buy or if I don't buy. So that is a good thing. That is a fair thing to do, because then after 3 months, if your friend walks out, you still have a $10,000, and then you can just sign the contract with the other person or sell the house. Or in another case scenario, that your friend will purchase the house for $500,000 and you still keep the premium, $10,000. So the option works the same way. So I think many people knows about the option is a regular option where you can write call option and put option. So if I show you, let me know if you guys can see this, right? Option PDF, you can see it, right?
Yes.
Okay, yeah, because sometimes sharing it's, okay. So here, usually most people do this kind of option. call option and put option. So basically what the call option and put option they do is they pay the premium in anticipation that the stock price will go high or low based on whatever they want to do. What we are going to do is we are going to do these third and fourth category, covered call and secure cash put. We don't want to pay premium. We want to receive the premium. When you pay the premium, you are a gambler in a casino terms. When you receive the premium, you are a house. The probability of winning more with the number 3 and 4 than number 1 and 2. So most people usually they know about this call option and put option. They usually do that. And what we are interested in, we are trying to do the covered call and secure cash put. So now the first question comes in your mind that why would someone pay you the premium? Why I would pay you the premium when I can buy the stock or share going into the market? So if the share is of it's $45 share, I want to buy 1,000 share, I just go into the market, buy $45,000 worth of share rather than paying you premium and holding you, paying you premium, which I know that I will lose in any case. So mainly what happened that you have to understand this one thing, that when you are trying to, let's say, you know that the Apple is right now trading at $150 and you want to, you know that some new products are coming and you think that the Apple yeah, so you think that okay, the Apple is coming up within the next 3 months with the new product and that's going to be blockbuster and Apple share is going to move north to the $150. You don't know, it might be 180, 200, you don't know, right? So, but you want to take advantage of it. And let's say you are working for Apple and you have an insight that this product is going to be blockbuster. So now if you want to purchase 100 share through the market, you have to come up with the $15,000. But let's say you don't have the $15,000. And so in that case, what you can do is you can buy the option one contract. So in the option, always in the option terms, one contract is equal to 100 share. So what you're going to do is you're going to buy one contract and like saying that I will purchase it at $150. Okay, and you decide the expiration. Now you know that when after 3 months, let's say Apple moves from 150 to 180, you could have made here $18,000. So you could have sold it for $18,000, get $3,000 profit. Here, let's say you pay for the one contract $500 premium. Now this contract is worth $3,500 because the value has been increased from Apple value increased from 150 to 180, and usually they go by dollar to dollar many times. So here also you made $3,000. The only difference is here you have to invest 15,000. Here you have to invest $500. So this is the basic thing why people want to do option. This is one of the criteria they do option. There are so many other criteria like let's say you are a long-term investor and you bought Tesla, and you bought Tesla at $300. Okay, and let's say Tesla moved down to 1,000, so it's went up to the $1,000. Now you are a little bit confused. You are thinking that what should I do? Should I sell it, take profit, pay tax on it? What should I do? Then you think, okay, you know what? I will be happy if I can sell my Tesla share for $800 at least. If it goes below $800, it's going to be a little bit, I will lose a lot of profit. So in this scenario, the person is trying to protect his profit. So what he will do, he said, I will sell my Tesla at $800. And he will buy the option or for the downward protection. So what happened that in any case scenario, if Tesla go down to $25, he would be still able to sell it for $800. So at least he lost $200 profit from 1,000 to 800, but he still made a good amount of money, $500 on investment. So these two scenarios are main scenario where people wants to do option and they will pay the option price. And that is the reason why somebody pay premium. Those two are major reason for people to pay the premium. So now how we receive the premium. So we will going to do first covered call. So it's very, very, what's going to happen that it's very, very straightforward. Okay. Covered call, whenever you want to write covered call, you need 100 shares of that particular asset or stock. So let's say if I want to write the covered call for Apple, okay, if I want to write the covered call for Apple, I need 100 stocks of Apple in my account. Now, I usually follow the Buffett strategy for the long-term investment. And believe me that the long-term investment always makes good amount of profit because you pay less on taxes and everything. But there are some disadvantages with also long-term investment. And I've been searching for removing those disadvantages. And the covered call and secure cash put will help you to remove those disadvantages. The disadvantage I will show you right now. Hold on. So let's say we go to the Coca-Cola. Coca-Cola is Warren Buffett have bought about $1.3 billion worth of stock around 1987. So 1987, probably he spent around 1.2, 1.3 billion. Now it's worth about 25 billion. So it's about 1987. So another 30, 40, and 40, 45 years, he made a good amount of money, and he didn't sell any single share of, so he hasn't paid any capital gain tax or anything. And plus the dividend is now almost whatever the yearly dividend. So he's getting a yearly dividend about $1.84, which is now his cost of purchased. So long-term investment always makes sense if you pick the right company, and if you know that company is going to last for more than 20 years or 15, 20 years, then you always make a money. Now here I will show you what happened. Now Buffett cannot do this. He probably knew, but he cannot do this because he has a very large account. He cannot go in and out like us. But let me show you this. So you know that there was a dot-com bubble happened, and then it break around 2000. So let's say go to 2014, okay. let's see.
Jai.
Yes.
તારે પેલા સ્ટોક વાળાનો વિડીયો ઝૂમ કોલ છે તારે શીખવું હોય તો if you join I send you the link if you want to join if you not do anything
Okay, so if you look here, you can probably see here, the Coca-Cola was trading here around $30. So that was June 2000. Okay. So if you are a long-term investor, usually people, you know, like most time the long-term investor, they don't look at even at the stocks, they keep it and they can get dividend and they're happy with it. But here in this case, if you see here, the Coca-Cola was trading at $31, which was about September 2000. The next time it traded $31, that was 7 years later in November 2007. No doubt you got all this dividend, but stock didn't go anywhere. Stock was right there from $31 to $31 here. Then again, the crash came, fell down, then moved down to here around $31 again. So in essence, you kept the stock for 10 years and stock didn't do anything except paying you dividend. So this was the shortfall with the long-term strategy. And the stagnant period will come. They will come with any company, you name it. If the company is going to last for more than 20 years, 30 years, there are going to be stagnant period for the decade, more than decade. Okay, here what happened that you are only getting probably, so 9 cents, probably all together, you probably have received $6 in dividend, $6 or $7 in dividend. But the stock appreciation didn't happen because stock was anyway, that was a different story that I can cover in sometime in different topics, but the stock was very highly expensive in terms of the PE ratio. And that's why it took the decade to reach to the $31. So this is one example. Then if you see Microsoft, so the dot-com bubble came. And so if you, let's say if you have bought Microsoft around $53, that was March 2000. People think that, okay, the crash is done and it's very good price to buy Microsoft. You bought it $53 or you bought it here somewhere $32, right? And until Satya Nadella come. Okay, so here Microsoft is still at $46, okay? And that was like 14 years. So if you see 14 years, Microsoft didn't do anything. It increased the sales every year, it increased the revenue every year, but the stock price did not reflect it. So these are the problem with the long-term strategy. And in the long-term strategy, when the stagnant period comes, if it's 1 year, 2 year, 3 year, that's fine. But when the period lasts for more than a decade, and you have the heavily, like Buffett always does, like I do, probably my 10 or 15% of my whole portfolio in one company. And if I have one company, I have invested 15% of my portfolio, which didn't appreciate for 14 years, I'm not going to beat S&P. There is no way I can beat S&P. So that was the problem with the long-term strategy. And I was trying to find it out the answer, how we can figure it out that we can keep the long-term company for the long time, but at the same time, we generate the income, we reduce the price, what we have paid. So in these two instances, and there are many more examples. If you want to check, you can always put the symbol here, and then you can change the range from 2000, especially if you take any technology company and put 2000 and then try to see when the price recovered. Even here, the price didn't even reach to the $53. Okay, so after 1 year, it reached to the $53. So almost 15 years. So the almost 15 years, there was a zero appreciation. You got dividend, but this dividend was very, very low dividend. And the dividend start even in 2004. And the maximum dividend you could have get it is $1.20 per year. $1.24. So hopefully you should have got probably dividend or $6 or $7 again, $7 or $8. You can reduce your price $53 from $7. But apart from that, there was no appreciation. So that's why the covered call is very, very important. And now I will show you why. Let's go to the thing. So usually I use this site barchart.com. I'm going to put the copy of the URL here in your chat box. Okay, 1 minute. Okay, so because there are some brokerage companies, and there is one particular figure I want you guys to familiar with when you do the covered call or anything. Many brokerage company has that availability when you put the trade, but sometimes you don't have that kind of facility to look at. So when we write covered call, so we go with the basic things about covered call. Okay, the first thing I want to explain you, out of all these table, okay, this is called calls. If the strike price is what is it? Oh, this is SPY. Let's go to okay. So here are the expiration. So what the expiration usually for very good company? For very good company, you can get weekly expiration. You can do, now let's say you don't have time to do weekly. Believe me, it takes 5 minutes. It doesn't take more than that. And if you have a 15% portfolio, just a second. Quresh, close this door. I'm sorry. So usually it's in the weekly expiration. You can also do some people do with the index. We will go later on that index ETF, but I'm just giving you example of Amazon. So you can see that the next expiration is March 3, then March 10, March 17, March 24, March 31st. You can go all the way up to 2025 December. So this is the expiration. Expiration is, remember I told you in the beginning, there was a 3-month contract we signed. Then midnight of that expiration, if you buy or don't buy, you will walk away with $10,000 premium. So expiration is exactly the same thing. What's going to happen that at expiration, whatever price you have put, if it doesn't reach that, then you keep the premium and you keep the shares. And so we will go into detail that one. But the expiration is the main thing you want to know. The strike price. Strike price means what price you want to sell your stock. Okay. Now, you will see there are two shadows here, right? The one is a green shadow, and then another one is a white and gray shadow. So whenever the green, what the green shadow indicates, any strike price in the green shadow means that option is in money. Why option is in money? Because what is current price today? Today is the close of Friday, $93.50, right? That was the close price of Amazon. So if you go to the bar chart, anything below $93, it's called option in money. Just keep this thing as simple as possible. Keep thinking like whenever the strike price is below the market price, the option is in money. When the strike price above the market price, option is out of money. Okay, what we are interested in out of money options. We don't want to sell our stock. So this is a green shadow. And another term you want to get familiar with is delta. Okay, this is the delta. This is very important. Only these two terms you have to know. You don't need to know any other thing. So when I talk about delta, like here you see, let's say here, when the delta is very close to market price, at the money. So here is the option at the money. So there are three things: option out of money, option at the money, option in the money. So whenever option at the money, usually delta is 50. So what is the delta 50 means? Sorry, here this is showing the wrong thing. It should not be 0.80. It should be 0.50. Let me see if I can. Okay, probably because of the expiration. Let's see now. It should be around 0.50. Okay, yeah. So this is close. So when the price is near to the market price, option delta value usually is 0.50 or 50%. What does that indicate? That there are 50% chance that option get acquired or option get executed or option don't get executed. It looks a little bit complicated right now, but it's very simple. I will show you how. When you also, this delta 50 also show you the probability. So that delta 50 means 50% chance. Delta 47 means 47% chance that your option get executed. What we want is, we don't want our option to assign or execute it. Why? Because we don't want to sell share. We are just interested in premium. Now there are people, they do short-term investing and they don't care. So for them, they pick the delta 50, close the maximum probability, where their option get assigned because they get maximum premium. If you see here, like delta 50, you get $2.13 premium. As you go far from delta, the probability decrease. Here is the probability 1%, and you get only 3 cents, because there would be no chance, or there is only 1% chance that by March 3, Amazon, which is right now trading at $93, would trade at 109. The chances are very less, so you will get very less premium. So only 3 things you have to know: expiration, strike price, delta. When you can do delta, remember, if you go up in the delta, you will get more premium, but there are more chances that your share will be taken away. Okay, so let's say we go with the real example. Okay, let's say you have Amazon share. Okay, Amazon, let's go here. Let's say you have bought Amazon share. $100 share, you bought it at $85. Okay. Okay. Now you have 100 shares in your account, right? So in traditional system, what we were doing is that 100 shares will just lying there. The 1 month it go to 95, 1 month it go to 80, 1 month it go to 75, 1 month it go to 100, 110. But it's just lying there. It's just sitting there. The value on the paper will change, but nothing else happen. Okay. So now we come here and I'm showing you the weekly example, right? Now if you don't want to do weekly, you select 1 month. So what is a month? What is a month is from now is March 24. So it says 20 days, 28 days to expire. So I'm showing you, but weekly you will get a lot more premium when you accumulate and when you convert it into yearly. So I will show you how. Like, okay, so 2003 March, and you have the share of $8,500, $85 price. Okay. Now we don't want to do delta 50 because we don't want to sell our share. There are chances that if you put $93 strike price, that you will sell it for $93. I mean, you can do that. You will get $213 premium. So let's say if you say, I'm going to sell it $93 by if Amazon closes $893 or above by March 3. So here is, we selected expiration March 3. So what we did is we said, okay, we're going to sell it to you for $93. If Amazon trading up around 93 or above 93, I will sell you the stock, my stock. Now, in this scenario, you got the stock for $8,500. You sold it for, let's say that Amazon March 3 close. Amazon was trading at $96. Okay, so you wrote the contract with the third party that you will sell it for $93 if Amazon closes $893 or above 93 by March 3. But in the March 3, what happened? The Amazon was trading at $96. So you have to sell your 100 share. Okay, but here the fellow gave you the premium, $2.13. So for 100 share, you got $213 premium. For us, the base, so on March 3, what happened in this scenario? That you will sell your shares for $9,300. Even though the stock is at $96, but you have to sell it for $9,300 because you made a contract with the person. So you gain $85. I sometimes have to use calculator for small. 93 minus 85.
800.
$800 plus you keep the premium $213. This is the first scenario. What happened? You made $1,000. First scenario, right? Now let's say March 3, Amazon closed. Amazon was trading exactly $93. Then again, by law, you have to sell your shares. But here one possibility. Here, what is the one possibility? That the person is not going to make any money, because the person who paid the premium to you, he paid $213 premium. So even though he get it at $93, he's not going to make any money. So in here it's going to happen 9,300. Here is going to be $0 profit. Oh, sorry, no, this is right. 8,500, right? Okay, so in this case scenario, what's going to happen, that because it's trading right at $93, he's not going to make money. So he either executed or he won't execute it. If he don't execute it, then you keep 100 shares. If doesn't get executed, then you don't get $800 profit. Okay, because you are not selling your share. So you get only $213 premium, but you also have your 100 shares. If he executed, then it's going to be the same like above scenario. Okay, and what you do, that in this case, it's a lot easier for you, that because it closed at $93, just go into the market and buy at $93 and write another contract and keep earning the premium. The third case scenario, what happened? That Amazon closed below 93. Okay, here what's going to happen, you won't share your share, because the contract says that only you required to share your sales if it's 93 or above 93. Here it is trading at $90. You don't have to sell your share. You keep the premium $213. Okay, and then what you can do is you can just write down another contract for next week. So this is so. So I use I use Merrill Lynch, Bank of America Merrill Lynch, but you can use any covered call provider, any like Fidelity, Charles Schwab, Wells Fargo, any brokerage firm you can use. They all have these things. So you just have to apply for the application. You have to just apply for the application on your option trading. Okay, now we think about this one here. So this is what I do, right? Now let's say let's say I have my case scenario, let's say I have the 100 share. Okay, so what I will do is, I don't want to sell my share $8,500. I want to keep Amazon for long term. Okay, but I want to earn income. So think like this: you have an apartment, you have invested in apartment. So basically you have 100 shares of a particular company. You have invested in apartment is vacant because you don't go visit there. It's just sitting there and it appreciating value year by year. But that's it. You are not generating any income from it. What we are doing is, we have an apartment, we are renting out. Okay. What we are doing is, I have 100 stock. I will give it to you. I will show you that you cannot lose your share. There is a way you cannot lose your share if you don't want to sell your share. So what you are doing is, you are renting your apartment for 15,000 rupees or 20,000 rupees to someone, earning the income, as well as the property value is appreciated.
Recording in progress.
I think somebody has to mute their voice. Sorry, Mike. I think it comes.
Yeah, I don't. He's not responding.
Okay. So now, in my case, what I will do. Okay. So I want to write. Why I want to write weekly also, I will show you this. Okay. Let's go to the weekly. Now, think of this, that Amazon share, I have a $85 Amazon share sitting in my account. Remember, to write covered call, you need shares in your account. How many shares? 100. If you have a 120 shares, you can only write the contract for 100 shares. You can only write in multiples of 100. So if you have a 150 share, you can just write for contract for 100 share. So that's, you have to keep it in your mind. Now, let's say what I do is I want to keep it for long term. I don't want to lose my share. I'm sorry, I have to tell you one more thing. The delta, which also shows the probability, it also shows the rate of option price movement. Okay, and that is very important. So if you think this one, it's delta 0.56. So if you write contract at this price, there are 56% chance that your shares will be taken away. And there are 44% chance that it won't happen. For that, you will get $213 premium. Also, the delta show you the price movement. When you write a delta 0.56, if the stock moves $1, the option premium move 56 cents. So if you see here, if you keep going deep in money means stock price is $93 and strike price is $50. Option is definitely is deep in money. Option will trade as a stock because the delta is going to be 100. So $1 value change in the stock, $1 change in the option premium. Why it happens? Because it's in deep in the money. So if you see the deep in money, if you add the premium plus strike price, you will get the market price. So 50 plus 42.85. Any option deep in money always comes to the close to the market price, $93. 60 plus 36, so $96. 65, 31, 70, 24, $94. 75, 18. So that is the delta. And as I said, the delta has a two thing. It shows you probability and it shows you if the $1 movement happen in the stock, what movement happen into your option price, option premium. So now let's say for me, I want to go to delta 10. Okay. I don't care. I just get a 23 cent. So what I'm doing is I'm selecting expiration 1 week from now. I have a stock that I bought at $85. I don't want to sell them. So I'm going for the low probability of 10. So here, delta is around 10 is here, 0.11, 0.08. So between $99 and $100. Let's say they are paying me $23 because you get 23 cents per share. So what I will receive is $23. But remember, the chance of this probability is very low. I have a chance that only 10%, that is a probability of 10% that my stock will be taken away. 90% probability that nothing would happen to my stock. So most likely what's going to happen that I'm going to keep this premium and stock will never reach to the $99. If it reached to $99, then I will show you $93, sorry. Then there is a different method you can do. Depend if you want to keep your shares. There is another strategy. If you don't want to keep your share, you can sell it for $93, get your profit, and plus you keep the premium. But think about this one. This is for just 1 week, right? So let's say you have a 4 week. So that would make, 4 week in 52. So we can get the, 12. You will receive $1,100 for 1 year. Within a 1 year, you will receive $1,100 if your premium, if your option expire worthless every single time. So now let's say it's not going to happen that it expire worthless every single time. Even at the low probability of delta 10, I will remove $250 from this because it's not going to happen every single time you win, right? So let's remove $250. $850, I'm getting income. I'm generating income from my Amazon share that are just sitting in my account. Well, what is that? $854 return on investment for $8,500. You get 10% dividend and you still have your shares. And if you are lucky, you can get more, like $1,100. And now let's say this is the one case scenario I showed you, that on the weekly, because see the weekly, you have to do a little bit more work, and that's why it pays you a lot. Now we go back to here. I'm changing this one to monthly. So what is the next month now? March 3, April 6. So let's say you are writing the contract on March 3 and you are going 1 month out. Again, follow the same rule. Delta, go to 10. Where is the 10 delta? It's here. So you should get probably premium between around 49 cents. Okay. So in this case, what happened that someone will say you know, Manan, I don't have the time to do weekly things. Every Friday I cannot sit. Okay, then do monthly. You have to sit only once a month. So in this case, you will receive a delta 10. We are keeping the probability to very low, 10%, 49 cents. So in this case scenario, what happened? You will receive the premium $49 multiplied by 12. And that would be $588. Okay. See, you can see the difference in the premium. So if you do weekly for the same probability, even we knock down the original price, original was 1100. Let me put back this one. This is for 1 year also. Now, because you're doing less work, so you are getting less premium. Now, let's say you want to do yearly. Yeah, someone says, okay, man, I only want to do yearly. I just want to do once a year. Okay, so March, the next year comes down to about March 15, 2024. Okay, you go to delta 10. And you said that I will sell my stock for $160. Delta 10, you will receive premium $1.39. So in this case, when you go for 1 year, you only receiving $139 times 1. You can see that premium drop drastically because you are doing once a year. Now, I used to do long term. The reason why you can do long term is that in this case, you will receive $23. Actually, now it doesn't make any sense to do that way, but I used to do it because what happened that I get upfront lot big amount, like 15,000, 20,000, 30,000. If I do weekly, the same thing would I get 120,000. But remember that 120,000 will come slowly because every month it will be deposited. Here I get upfront, and I forgot to tell you guys one thing. You receive the premium the day you write the premium. Okay, you write the contract. It's not the day that your contract expire and you receive the premium. As soon as you write the contract, the premium fall in your account. So whatever you want to do with your premium, you can do it. Who pays premium? Okay, so remember I
Hey,
showed
Manan,
you,
quick
remember
question.
in the beginning I show you that there are people who wants to gamble, they will pay you the premium. So there is always somebody is going to pay the premium. There is always somebody is going to receive the premium. There are two case scenario, probably you missed it in the beginning, but if I quickly recap, so one is the person who doesn't want to lose his profit. So he bought the Tesla share at $300. Tesla went up to $1,000. He's little bit confused and he's thinking that what should I do with my Tesla share? Should I take profit or not? And then he said, okay, you know what? I'm going to write the put option for $800. For that, he pays the premium. What he did is he locked up his profit $800. So even Tesla started to trade at $25, he will receive $800 for selling the stock. So he paid the premium to protect his profit. Sometimes people knows that the stock will move couple of dollars more, but they don't have enough money to purchase it. Like if they want to buy 100 share, they have to spend $15,000 for Apple. They don't have $15,000, but they know that Apple will move $5 to $10 or $20, $30 within next 6 months. What they will do, they will buy option because option costs them less. So for $800, they get the same chance. If the stock moves 20 points, the option premium also moves to 20 points. So for $500 investment, he get the same amount of profit. So that's why they pay you the premium. So there is always pay you the and then another person who pays you the premium is like me, who doesn't want to lose their share. So what happened in this case scenario, let's say I wrote the option for what? Let's go back to March 3, okay? Okay, I wrote a delta 10 here, somewhere here, 23 cents, right? Okay, now what happened if something happened in 1 week? Fed says that they're going to reduce the interest rate by 0.75%. Okay, that will make a huge jump on the Amazon stocks. And Amazon now is trading at $102. Remember, when I wrote the contract, I said, if it's $99 or above, I will sell my shares. For that, you will give me $23 premium. Now it's trading at $103. If I let the contract expire, my shares will be sold at $99, even though Amazon is trading at $103. And that is the reason, because you are receiving the premium, so you are bound to the contract. But I want to keep it for long term, my share. So what I will do is Friday, I don't want to sell my share, so I will pay the premium. So what I will do is I will close my contract, and I said I want to void this contract, but there is a fee, okay? Because when you wrote the contract, it was $93. Amazon was trading at $93. Now Amazon trading at $99. Yeah, I will come to that point, Tejas. So Amazon has a 90, what I was saying, I forgot. Yeah, so what I paid I received the premium $23, right? But now Amazon is trading as 103. If I want to close my contract, it's not going to be as simple as paying $23 back, because these 23 cents now worth about $2. So if I want to buy contract back, I have to pay $200, not $23. And that's why what happened that I will lose money on my premium. Okay, but I will save my shares. Now think this as how many times it's going to happen. Like out of 100 times, let's say 10 times it happens that it reached to the contract and you have to pay the premium. That's fine, because we are doing it very low probability. Like around 10, delta 10 is the lowest premium, the lowest probability you get. Okay, so there are high chances that it's not going to happen. But if it happens, it's not going to happen that often. So now coming back to this Tejas question. So when I did a lot of different calculation, delta 30 is the best. Delta 30 will give you the best optimized premium for weekly, monthly, yearly. I'm not going for here delta 30 because it increases the risk also. So if someone is not, if someone doesn't mind that his share gets sold, then you always write at delta 50. Because you get a long premium. So usually, like people, what they do, let's say you are short-term investor, you are not a long-term investor. Okay, so what you do is go into the market. You buy 100 shares, $93. Okay, so you spend $9,300, right? Now you wrote the contract that you will sell it at 93. You don't want to make any money on your stock. Okay, so March 3 expiration, but you will get $213 premium. So what I did is I'm interested in premium. So I got $213 credited to my account. Now on March 3rd, if it's trading at $93, they will sell my share. I have the zero profit, zero loss, but I have a $213 premium. I will go into the market, buy again 100 share of whatever price is Amazon trading, write another contract, and keep doing that. If it's below $93, I'm going to keep this all $213, and I don't have to sell my shares also. So I again write delta 50, and I keep repeating that things. So if you are a short-term investor and you don't care about your stock, or if you are in the IRA, remember in the IRA, there is a huge opportunity if you want to do short-term things. You know why? Because let's say your share gets sold. Let's say you bought it at 87. You wrote contract for 93. So you are getting here about $6? Yeah, $600 here. Plus you are getting this $200 premium. Let's say it reached to the 93 and it got sold. You made $700, but remember, you're not going to pay any tax because it's IRA. So you go to the market next day, buy it at $93 again. And then write contract somewhere here that you will sell it for $99. At that time, the contract value would be, the premium would increase because it's close to 93. So you can do so many different ways. You can do the short term, you can do the long term, you can do, but you can get the premium. And think this as, now, if you guys are understand, until now, let me ask you this. Whoever have any question, just unmute it and ask me right now, so I can move to the another one more part.
Hey, Manan, so I used to do the long-term covered calls as well, just like you indicated. And I always thought that it allowed, that time is in your favor. So that as the stock goes up and down, and as it goes down, you can, you can get out of it and then wait until the stock again goes up. However, it seems like weekly or monthly, the frequency is higher and returns are higher. Does the risk go higher as well, or you're clearly just going by the delta and saying, hey,
actually risk goes low. So usually when I write a premium for long term, I write at delta 30. Okay, because delta 10 I don't get that much premium. So let's say, let me see here. So if you think 1 year out from today's date, think about this. If you want to write a delta 10, right, you get $1.39 premium. Now, in our case, just 1 week, we are getting a delta 10, 23 cents. So $1.43, you can cover that $1.43 in about 6 weeks. You can cover whole 1 year premium within 6 weeks.
Yeah.
So when you write a long-term contract, you want to go for delta 30 because it optimize the premium and you can see the good chunk of premium and the money. But again, if you write it at, let's say January, March, okay, and then I go to the delta 30 is here. So I get $5.55 premium. So I got like around $555 premium. But think about this, we are now at delta 30. So there are 30% chance that you get executed. When we are writing weekly, we are writing at delta 10 here. So there are only 10% chance that it get executed. So even when you go for the long term, and if you write for the delta 30, just think about that. When you write for weekly, the weekly is always be writing for 10, delta 10, because we want to make that small amount of money, 25 cents, 30 cents, 40 cents, with the more probability of getting succeeded.
Yeah, it does make sense. And even though you get called out, most likely because you're playing weekly, stock is not going to possibly run up significantly higher than you're having to pay back. Okay, got it.
So you can easily buy back, because let's say even it gets sold at 93, the next day, sorry. I cannot hear you properly. What was it? Hello?
Yeah, I think it seems like somebody forgot to put it on mute, Manan.
Oh, okay. Yeah, so yeah, that's what I've been doing this yearly things, so I can get a big chunk of money. And then what I was doing, that big chunk of money, I was buying the shares are undervalued. And then I was keep writing covered call for that things. But now if I maxed out all my investment, now I'm going back into the weekly, so I can generate more income. And my yearly premiums all been expired or going to expire. So I'm switching back to weekly, because weekly you generate a lot more. Even at delta, what I see between delta 10, delta 20, I just show you I just did this thing. like on, if you go for delta 15 for short term, you can get yearly return of 21%. Now, let's say out of this 21%, you're not going to win every single time. Just remove 4% or 5%. You still make 16%, 15% easily, because the probability at delta 15 is very low. So especially in this kind of market, especially the problem right now is high volatility. That's why we get burned out sometimes. But if it's a bearish market, you go for high delta. And if it's a bull market, go for low delta, because the price reach it very fast. So, but you can generate the income. I mean, it depend on what, like if you are interested in income, then go for delta 50, and then don't worry about appreciation of the stock. If you want to keep it for long term, but you still need some kind of income, like a renting your apartment, go for delta 30, 20, 10, 5, whatever makes you comfortable, and get that premium. And remember, I just wrote this for 100 share. It's getting very, very, like if you just do the 1000 share, it makes a completely different situation, because on 1000 share, 23 cents you are receiving weekly. You are receiving $230 weekly, multiply by, you are receiving $1,000, almost $1,900 per month, multiply by 12, you are receiving $11,000. If you go to the 5,000, if you have a lot more shares, these 23 cents add up so much. So 5,000 share, then you multiply, you will receive weekly $1,150 times, you will receive monthly $4,600, and multiply by 12. You receive about $55,000 premium. Now, let's say you don't get all 55,000 premium, you have to pay back and stuff. Probably 45,000 even you get it, 45,000 to 46,000. Also in the weekly, what happened, the time theta value decays so fast than the long-term option, and that where you make a lot of money. So like, is anybody, everyone is clear about until this point?
Yeah.
Yeah, I'm good.
Yeah, so I just want to go to one more step, but I don't know. I mean, yeah, I will go with that because that is also important. So here we did with the covered call, right? Now, remember that there was another thing was secure cash put. Okay, so again, goes on the same principle. What secure cash put, what it says that you keep the amount in your cash amount in your brokerage. So let's say you have a $10,000. You have a first option that you buy Amazon. Amazon, you buy at market price. So you pay $9,350. But there is another way also you can get premium. You go to the secure cash put. Okay. What we are doing is, we were saying that rather than buying at the market price at $90 or $95, whatever the $93, write the contract for 1 week. So what you will say that I will buy Amazon at 93 or below at the expiration. So if it goes below 93 or but if it stays above 93, I will keep the premium. So here what you're doing is, instead of going and directly buy the shares from the market, what you do is you write secure cash put. So when I write secure cash put, I write another contract with the people that I will buy 100 shares of Amazon at $93. For that, I will receive the premium of $151. Okay. So anyway, I want to buy it at $93 by going into the market, right? So rather than going into the market directly, what I did is I kept on my account $10,000. So that's why it is called secure cash put, because it's secure. The collateral I have put it there, $10,000. So brokerage company knows that he can, if we assign him $93, 100 shares, he has a money to pay for that. And that's why it called secure cash put. You are receiving $151. Now let's say first week, the Amazon stay above 93. So you didn't get assigned any share. So you wrote another contract. Again, you got about same premium, 151. The share didn't get assigned to you. Again, third week, you got 151. Share didn't assign to you. The fourth week, share assigned to you, 100 shares, let's say around $95. So now you have a $9,500, but your actual cost is less.
So one question, it cannot go to 95, right? It has to be 93 or less.
No. But see what happened, that once the option expire, the market price is going to be different, right? So
okay,
in this case, like, so let's say, okay, you wrote contract, it was $93, right? Let's say Amazon closed at 94. Okay. So the next day when you write for 94, 100 shares, because you are writing at market. Okay, 94. And what happened that week, it closed at 95. So you still keep your premium. You don't have to buy the share. Okay, then third week you wrote, because you want to wrote, you will get more premium if you write at a market price. So on third week, you wrote for $95.
so you have to keep contract updated every day or every week?
Yeah, depends on you. Like if you want to do every week, you can do every week. You can do every 2 weeks, every 3 weeks, 1 month. But see, when you are buying stock, if you are short-term investor, right? Then it doesn't make any difference, because you have to go follow this strategy, because you don't care if share gets assigned to you or don't get assigned to you. Because in my case, what happened, let's say I figured it out, Amazon is excellent buy at $93. I cannot write secure cash put 1 month out. What if Amazon reached to 120? If Amazon reached to 120, I have to buy it at 120. And for me, $93 was a very good price. So I let it go my premium. I go into the market, I buy 100 share at $93. And then I start writing covered call. So there are, we have a couple of people who have, Pratik. So yeah, the secure cash put can be done with margin. So that, let me give you that the good part about this secure cash put with the margin. When you write secure cash put with margin, it's hard to get secure cash put with margin approval. Okay, it's called level 4 or level 5 option trading. They won't give you the access to secure cash put margin, because brokerage sends the the problems, because let's say you have a margin account with a $300,000 ability, and you wrote the contract for 200,000, and suddenly the market drops and your market equity fall below 200,000. Now you cannot use that secure cash put. Brokerage cannot use that secure cash put to assign you the shares. And so before they approve you, but if they approve you, let me tell you one thing. I have the margin account. So let me show you one thing here. Tesla was trading at $1,000. Okay. I thought the Tesla should be good at, if I can buy Tesla if it's trading at $700. So Tesla was trading at $1,000. So I wrote secure cash put on a margin. So when I wrote secure cash put on margin, basically what secure cash was required is I have to put aside $70,000 for 1,000 share. Let's see, 1,000 share. Yeah. So I wrote one contract. So I have to put $70,000 cash on side. I cannot use that cash until this contract get expired, or they get assigned to me. But because I had a margin, I don't have to put cash on a side. Because I had a margin account, they did not even charge me interest on $70,000, which I have used as a collateral. They only start interest you on a collateral when they assign you shares. So in this case, what happened? I wrote secure cash put. Let's say I have a ability to write secure. I have the margin by buying power $500,000. Okay, so you don't want to do like extreme, like 450,000 on secure cash put. I have a $70,000 secure cash put I wrote. Okay, the brokerage knows that he has some $500,000 margin availability. So they said, okay, we will allow you to write this secure cash put for $70,000. Now, they paid me, I wrote it for 1 year, okay? So they paid me $70,000 premium. Okay, now, let's say 6 months after, see, I wrote it that, okay, I'm going to buy only at $700. 6 months after, Tesla fall down to 700, okay? So let's say they assign me 100 shares. So, and let's say I didn't have the cash and I used the margin. Then after, when they assign me $70,000, they're starting to charge me margin interest 4.5 or whatever percentage at that point. But this $17,000, I got it immediately. So if you have a margin, it's, I mean, I fight with them and I say, look, I need it, otherwise I'm transferring my account to somewhere else. Because they are very, they knows that people can misuse it. And especially like if you go very close to your margin ability, then if the market, something happened to market and your margin is not available and you're not able to, even they want to assign you 100 share, but you don't have any money, then the brokerage company comes in the problem. So whenever they give you margin account, secure cash put, they do a lot of how many years of experience you have in kind of stuff, but it's worth fighting for. And you don't want to over exaggerate so that you also had a problem because you have to deposit some kind of money immediately if your margin is not meeting up. But see, this $17,000 premium I received upfront, and I bought some other stock. So this is a good thing for me. I don't want to buy Tesla at $1,000. I want to buy at $700. So while I'm waiting the Tesla stock goes down, they paid me $17,000 premium. And I use those premium to buy other stocks, good companies. Now, if Tesla fall down to 500, definitely they're going to assign me for $70,000. But this is the same thing like, let's say you bought Tesla on the market at $700. You didn't know that within 2 months it will fall down to 500. So once you know that you are paying sensible price, and if you have a margin thing, the secure cash put is awesome things to do. Especially if you are not, if Tesla is trading at $700, then don't write the secure cash put to buy at $300. I mean, you can write it, but the problem what happened that if I want to acquire this company and I'm paying sensible price for that, I usually go ahead and buy it. I usually go ahead and buy it if it's a sensible price, if whatever price I have calculated, if it's near there. Because just recently what happened, the NVIDIA fall down to 120, 130, and there are, what happened, we wrote some secure cash put, but it would be worth it if I had bought it in the market at $130. Now, my secure cash put was 1 week or 2 week expire, and then NVIDIA keep moving up. Now it's $230, $100 it moved. So it makes sense that if you really need, if you really think it's a good price, then it's up to you. If you want premium, keep writing secure cash put. If you want to keep it for long term, and if you believe in the price, then don't wait for it. Just buy it in the open market, and then starting to write cover calls. So these things happen here also. You can write. So I can write a secure cash put here until they assign me the share, 100 share. As soon as they assign me the 100 share, I'm going to start writing the covered call. And the same strategy, like the secure cash put, you can write at a market, okay? Because you get low, you can, so secure cash put, you can write at delta 50. So it's delta 50 is here. Because you want to purchase it, sorry, this is called put. Because you want to purchase this one. So they give you a lot of premium, $1.97. Okay, so if you do secure cash put, always write at 50, delta 50, so you can get assigned a share. First thing that you want to buy that company, then only go for it. Otherwise, you can use the same principle. If you don't want to buy the company and you just need the premium, then go for lower delta. So go for delta 10. That if it fall down to $88, you will purchase it, and pocket 27-cent premium. Keep pocketing 27-cent premium until they assign you the shares. Once they assign you the shares, go to the cover call. Go to the same strategy, go to delta 10. Keep writing the premium until you sell your share. And then repeat the cycle. So that is called wheel strategy. So there are so many people, they do wheel strategy. What they do is just they write secure cash put until their share gets assigned. Once the share gets assigned, they write covered call to sell the shares. What I do is, because I want to keep it for long term, I usually end up with what happened that sometimes I have to pay more premium than I received, because I want to keep my shares. I don't want to lose my shares. So I think this as a like kind of insurance business. And that's what I told people also. Like in insurance business, you keep receiving the premium. And that is the one thing that Warren Buffett used for Amir's fortune, because he has an insurance business. So in the insurance business, what happened? The premium comes. The premium comes, he has to pay the claims. But the paying claims, it's distributed for 10 years. It's not going to happen that immediately in 1 year he has to pay all the claims. So what he was taking advantage that whatever premium he was receiving, 20% of that premium he was keeping it for claim, which he knows that he ultimately has to pay the claims, and that's what's going to happen. 20% he kept it aside, 80% float. He started to invest in other companies because he know he has a time that all claims are not going to happen in the same year. So, and plus if it happened, he has kept the 20% on side. And then, so in the insurance business, the sum of claims, even though let's say you got 500, let's say I got $500,000 premium for covered call, right? And I paid $500,000 of premium in next 7 years to buy my covered call. Still, it makes a big difference because I got 500,000 upfront right now. So I invested in another company, and just think of as an installment, I have to keep giving back, but I have to keep giving back in 7 years. So if I keep giving back in 7 years, I don't have to pay any margin interest on it and nothing. And so I didn't make anything out of premium, let's say, but the $500,000 that I received it upfront, I invested in Amazon, Google, which worth was 2.5 to 3 million after 7 years. And that was the Buffett was doing. He has an insurance business, and I figured it out that you can do covered call. With covered call, you receive the premium. We don't need an income right now. Most of us, we don't need income. So reinvest that into your portfolio, and then keep reinvesting. Once in a while, it happens that you have to buy back your contract, paying high price, okay? But that should not discourage you, because that could happen for, let's say you do 100 transactions, probably 70 transactions will expire worthless. The other 30 transactions might you have to pay the premium, a higher premium, what you receive. But the premium, you keep receiving it. So that is strategy I am using it. So what I did is whatever the big chunk of premium I received, then market crash, because when market crash, my option value jump. So I close all option value with cheaper price. And then whatever the premium I had, I use that premium to buy the value companies. And once you purchase it, keep writing covered call, start writing covered call. And that's why I was keep insisting to people, write covered call and secure cash put, because most financial people will not tell you about this. They will never tell you about this thing. And even right now, like if you ask 90% of people, they know the put option and call option. They don't know covered call and secure cash put. They know how to get option and pay the premium, but they don't know how to receive the premium. So, and I think I have recorded this one. So if you guys have any question, I will take that question and then we can conclude it.
I have a question.
Yeah.
So when you keep buying and selling like this, you get premium, but aren't you have to worry about the wash shell, or that doesn't apply here?
No, wash shell won't happen. Generally won't happen. You know why? Because every option expiration in the price is treated as a one stock. Yeah. Because see, if you see the option, like let's see here, let me show you here. It only happens when when you do the same option. Now, so let's say Coca-Cola. See, this each option has a different contract name.
Okay.
So if, unless you trade the same option, every single option is a different contract. So if you have done with the contract with $59 one, that trade contract name is this one, and if you don't use that one, you don't get wash sell.
Okay. Even it's the
Because-
same underlying stock, but you can do different contract.
The stock is underlying same, but the options are different.
Okay.
Yeah, so you don't get wash sell unless you do for the same option.
Okay, makes sense. But premium, we have to pay tax if we are doing non-IRA. Yeah. Correct.
Yeah. Premium is probably short-term capital gain tax or whatever short-term tax. I don't know exactly, but probably it's not going to be the dividend based. It won't count as a dividend, so it's going to count as a short-term capital gain, and that's why you have to pay whatever in a short-term, whatever tax category you fall.
Makes sense. Okay.
But just think about it. It's like if you make 18%, and let's say you have to pay 40%, then you still make 12%.
Yeah.
Yeah. So I mean, it's not that bad. Because anyway, you are keeping your stock in the company, in the brokerage account, and it's going to go just up and down.
Correct.
So do you suggest that when there is more volatile market, you should stay out of these things?
What is it?
Would you suggest stay out of these calls and puts, secured puts, and when
No,
the market is
I
too
would
volatile?
say you need to always be in a market, even if it's volatile, because in the volatility, you will get a lot more premium. The only thing what you can do is drop your delta. So the chances of assigning or taking away is very less. But you want to be in a market. So rather than going for delta 30, go for delta 10, delta 5, go for delta 5. And when the market is steady and doesn't move or it goes sideways, you make a lot of money because most contract expire worthless.
Interesting. Okay.
Hey, Manan, I have a question.
Yes.
So if you have, like I have a couple stock like Neo and ChargePoint, those are I bought at like higher price. So should I do the price is down right now? So should we do the cover call now or just wait for the price to come up?
No, you do cover call right now. So what you can do, so one thing you remember, okay, you can always, you don't have to sell your stock.
Okay.
Like, okay, so what you are saying, let's say you bought Coca-Cola, right? And you bought it at $80 and Coca-Cola is right now $60. So you are already loss of $20, right?
Yeah.
Right. So you want to do weekly contract, okay? Then in weekly contract, what you do is you go to, where is my bar chart? Okay. I go to the weekly contract, right? Then I go to the delta 10, okay, delta 5 or 10. Even I'm not getting anything, okay? Even $9 I'm getting. Okay, that's fine. at least I get $9, right? Because Coca-Cola is very non-volatile company, so you get very less premium, or you can go above like delta. I don't see any between 0.45 and 0.15 cent, 0.15 delta, 45 or delta, but you can go for delta 30. But there is no delta 30. I don't see it. The point is like you write down for 9 cents, okay, $61 for 1 week. You get a $9, okay. Now, let's say at the expiration. So today is a Friday. This Friday, 4 o'clock is going to expire. Okay, before you have to make decision, because if the Friday closing, if Coca-Cola close at 62, you will sell your share at $61, but you bought it at around $85 or something. So you don't want to sell your share. So what I will do is that Friday, I will close this contract, pay the premium, and I'll keep my shares. But it's not going to happen that every single time it reached the strike price. And then slowly, when Coca-Cola started to move to $85 onwards, you can go more aggressively, because if you sell your share, you still get the profit plus get premium. So that's what I do with the strategy if I don't want to keep it for long term.
But instead of closing, can we roll it?
You can roll it. But basically, you can roll it means you close the previous contract, and then so what
Open
I do
the new
is
one.
I close this contract. Now they pay me $9 premium. I have to pay probably $36. Okay, because see, now it's delta 50. This one, it's market price. The market price came here. So this premium, you won't be able to release your shares or void your contract just paying the same amount of premium of $9. That is the catch. You have to pay more premium than what you received. But this is one time. So $27 you paid and you are free. Now you write another contract delta 10. So it's again, you get $9. And that would go up to $63. And Coca-Cola did not reach to 63. So you kept the $10. Again, write the delta 10, again get a $10, again write the delta 10. Now it reached to the delta, pay the premium, release your shares, and go and keep writing delta 10. Just write as a mechanical method, write delta 10, delta 10, delta 10. What happened that ultimately out of your 100 transactions, 60 transactions, you have the premium, 30 or 40 transactions might be in the worst case scenario, you will have to pay the premium. But again, this is for one stock. If you have a 20 stock, not all stocks are going to do the same thing. There are stocks that are going to remain flat for 1 year, 2 year, 3 year, where you're going to make up your premium, whatever extra premium you have paid to close your contract for Coke. So that's what I do. But yeah, but like, don't wait it. Go for delta 10 or 15 or 20. If it reaches to that price, roll the contract.
Okay.
Pay the price.
Do you recommend weekly or monthly?
Weekly, you will get lot more premium, but weekly requires little bit
A lot
more
of time, yeah.
Little bit more work on time, because you have to keep watching it, because weekly what happened that if it reached the strike price in the middle of the week, and if you are not aware of it and you are not on top of it, they can sell.
Yeah.
So they can sell before your contract expiration, and that is the problem with American option. European option, they cannot sell until the contract expire after 4 p.m. So with American option, we always have that problem. So if you are not on top of it and you just missed it, then they will probably sell your share at loss.
Okay. So like other, like one more question. If you have like 400 stocks, do you want to do the option for all 400 or just do for half and then hold the other one in case the price shoot up?
It's completely up to you. So for me, my whole portfolio is in covered call. Okay, every single stock is in covered call. So it's up to the individual, right? In some individual wants to do half covered call and half stocks they want to keep. Now, if you think partial way to do, then do in your IRA, because in IRA you don't pay capital gain tax, and you don't pay on your option premium also.
No, the main concern is like let's say the Apple. If you do the like call and if the price goes $10 up, then you like all the stocks will be call out. And if the price goes 20% up, then you lose that profit margin.
So that's why you have to think this as a insurance business. You have to pay the claim sometimes, right?
Okay. Yeah.
Yeah, it's like auto insurance. Like you're not getting premium and you don't like it's not going to happen that you just receive the premium and nobody claims for the car accident.
Correct. Yeah.
Yeah. So I look as an insurance. Sometimes you have to pay.
All right.
And if you are not like if you don't have profit loss 0 to 0, and if you don't want to pay premium and you are happy to let it go your shares, do that way, then go back to the market, buy it again, and then write covered call again.
Okay. Yeah.
So if anyone have more question, I can answer. Otherwise, you can also question me on my WhatsApp, our WhatsApp group. I should be able to. I think first 4 or 5 trade you will find little bit difficult, but believe me, I have so many my friends, they first initially found little bit difficult. They were calling me, but after 4 or 5 trades, they are on their own. They don't even call for any help. Like they figure it out. It takes about 4 or 5 trades you have to do by yourself.
So what website you suggest for study and research? Is this the good website, bar chart, or?
And I use the bar chart because I just need a delta 10 values. If brokerage, sometimes brokerage have the integrated delta values in your option chain. So then you don't have to go to the bar chart.
Okay.
Yeah. More, I think probably my brokerage is Merrill Lynch.
Yep.
And in a traditional trade option chain, they don't show me the delta value.
Mm-hmm. And who comes up with this logic of 10% delta or this price and this contract? Because for some stocks, I don't see this many options or this many. They only have
so 50. Like yeah. So what in my experience? So like if I see that's the if you have a very huge portfolio, then sometimes 10 cents adds up so much, right? So why to take unnecessary risk and go for higher delta? Because anyway you can make a good amount of money monthly. So but it's completely up to the person. You can do up to delta 50, but the things what happened that delta 50 you get more premium but there are very high chances that you will assign share or your shares will be taken away.
No, what I was trying to say that like you show example of Amazon where I see a lot of options of above and below, but if I try to look at something else and they only had a few options listed.
Yeah, then probably then it won't work that much, because if it's small cap in very volatile company, you won't have that many options. Even you won't see any trading.
Correct.
So,
Yeah.
so if you want to do trade, but there is nobody, there is no counterparty.
Correct.
So in that case, you just have to let it go, that company. You know, don't
Yeah.
write cover call.
Yeah.
And you can use the same principle, this principle for your SPY ETF. So let's say you don't want to go to the individual company, you can do the same thing with ETF. What is it?
No, I got hot mic. Nothing else. So another question is there any well-known stocks which are working well for the covered calls? So we can always focus
Any
on.
stocks, so probably if you go for very steady stocks like Coca-Cola, you will receive very less premium, right? Because it's very steady, very non-volatile. One of the factor in the premium is the volatility. If you go for moderately volatile stock, you get a good amount of premium. Now, if you go for highly volatile stock, you get big amount of premium, huge amount of premium. So like if you go for MicroStrategy, I think people are playing with MicroStrategy, right? And if I go for, let's say, Delta 10, all the way up to here, even Delta 10, they are paying me $1.44. So if I have 100 share, I get $144. No doubt I have to invest $29,750, but they pay you lot premium even at Delta 10. If you go to Delta 30, you get $520 per week. Yeah, so as the more volatile stock, you get more premium.
Yep.
So, but I go for like not too volatile and not too much like you have, if you can do the moderately volatile like Google, Apple, Amazon, you do okay. You get good amount of premium. Well, probably you don't get that good amount of premium with Coca-Cola, Pepsi, or like a Dow Chemical. Those established companies, they don't move $1 or $2, so they don't give you that much premium, but they are also worth trying. Even you get 10 cents, 15 cents. And if you're getting $15, you are getting yearly or a monthly $60. It pays off your one restaurant bill. So it's just that you have to spend some time, you know, and it doesn't require that much time also. Like I have only my whole portfolio, I don't believe in diversify so much. So my whole portfolio is only in 11 or 12 companies. So every Friday I sit about 10 o'clock. By 11:30, 12, I'm done with every company. Whatever I have to do, only 2 hours. And it takes 2 hours because I wrote down every single transaction in my Excel sheet. And that's why it takes more time. If you don't care about transaction writing or anything, you should be done in half an hour.
Yeah.
Okay, then I think if you have any more
Manan, one question, Manan.
Sure.
One question. Friday is a better day or Monday is a better day to write calls or puts? And the reason behind it?
Yeah, it's only the reason is third week of Friday, because third week of Friday, usually you get a good bid and ask because everyone is doing the third week on Friday. The option expires kind of stuff. So if you do Friday, it is better because you will have a so for example, if your delta is very close to 50, I mean 10 or 15, or for the standard company like Amazon and Apple, you won't find that much big difference in bid and ask. But then if you go for the second class company, then like bid and ask will show you 15-cent bid and 30-cent ask. And if you put the middle 22-cent, still your order doesn't get filled because there is not that much volume or transaction. So the Friday, third week of Friday, usually the transaction happen most. So the bid and ask is, the difference between bid and ask is very low. So you can get a good amount of premium, but it's, you can do any day, because when you write on contract on Monday, it accounts that Saturday, Sunday, you don't kill those 2 days from the week, because if you have wrote on Friday, they have taken in account that Saturday and Sunday is a weekend and the premium reflected that way. So it's not like some people say that I write Friday, so anyway 2 days are gone on Monday, but it doesn't happen, because Friday, Saturday, Sunday's premium reflection is already happening to the Friday, whatever you get it.
So the theta is not impacted.
Yeah,
but
theta
Friday,
will not. Yeah.
like Friday, because of the volume, the spread is less.
Yeah.
Gotcha.
Only the bid and ask.
Yeah. So bid and ask spread is less. Okay.
Yeah, only the bid and ask is a problem. Because if you have a, like, then sometimes what I have to do is like, I have to sell it at lower bid, because I don't want to keep it on limit order. And I want to check every 10 minutes it went through or not. So that where it makes difference.
Okay. Yeah, that was the only question I had. Thanks.
Okay.
Yeah, this is Bhavesh, by the way.
And Bhavesh is my best friend. Okay, it's very good. He's learning a lot and he's doing very good.
Guys, whoever is new here, I'm just, I joined with Manan for the Zoom last time. Also, I joined just to get knowledge. I started this strategy in October, and I'm repeating, I think, the same story again. I started this strategy in like October. Like I've been doing stocks for past 25, 30 years. But I started implementing just these two strategies, cover calls and cash secure put. And it has really worked for me for sure. So, as I've gone through the dot-com bubble, I've gone through the housing crashes, all that has passed, but this strategy really helps in the long run. That's what I thought. And I just started implementing in October. So, and so far I'm in positive territory. So.
Yeah, thank you, Bhavesh.
Thanks.
But, yeah. I mean, this strategy should work. There is no, probably you will receive some less. Like if I say 21% in 1 year, probably you will receive 16%. And another year, you probably receive 24%. But it's going to give you if you put your time, effort, it will definitely pay you. So that's why I usually I only came to know these things 2-3 years ago. So I'm just thinking like 10 years ago, if I have known these things, my portfolio would be at a different place. I'm regret that I didn't know this 10 years ago. And that's why I urge everybody to learn. Then it's up to you. If it just learn the instrument. It's not that you have to use it. Okay, like there are 100 people or 200 people I have showed them how to use this instrument, and probably 20 or 25 people are using it, probably 30%, 25-30%. But at least you know the instrument. You know that there is an instrument. Especially just think about your kid who's in early 18s or 20. If you show him this strategy, I will guarantee you, he will be at 40 or 50, he will retire. Just by saving, first of all, the saving, I came from India, right? So in India, we don't have that concept of financial thing, right? like I came here and I started to seriously taking financial when I was 35 years old. I'm just thinking if I would know these things at 20, age of 20, it would be completely different thing. I did really good, even it started at 35. But at 20, it would be completely different. And that just think about Buffett. He started at 11. So these things, yeah.
Very true. Very true.
Okay, guys. So I will just conclude this, and I'm going to put it on YouTube, and I will share that link. It would be private link, so not going to be public, because in public I had to put disclosure and stuff, and I don't want to do that. So I will share you the link once the recording is available, and in the WhatsApp group, and other people who have missed it, and anyone anyone wants to learn anything, I don't have to go through again same thing. I will just send you the link, and that way it's easy for you guys to watch your own time convenient way.
So that will be a private YouTube link or something?
Yeah. I'm going to put private YouTube link.
Okay.
Yeah.
Otherwise, if you want to just share, there is a way. I can show you up to the call or something.
Sure. Yeah. Just show me how to do, like,
Absolutely.
otherwise I know how to put it on YouTube because I did few for YouTube things, and then I can just share instead of public. I just do the private link, and that should be fine. It won't go into the YouTube's crawl, so that should be fine.
Okay. Yeah, I will message you.
All right, no problem.
Thank you.
Thank you.
Thank
Bye.
you, really, Manan. This is like amazing knowledge. I really
Thank you.
appreciate it.
Thank you. Thank you.
Yeah, thank you,
I
Manan,
figured
yeah.
it out, like, okay, I learned how to make money. I want everyone to learn, at least whatever way it helps you. I feel good because when Bhavesh always called me, like, Manan, your strategy is so good. I made good amount of money, and it make me happy. Like I help someone with my knowledge. That's what makes me happy, and that's why I'm doing it, because I feel like at least everyone should know about it. Then if you want to
Yes.
do it, don't do it, then it's completely up to you. Yeah. Okay, guys. Bye.
Thank you, Manan. Thank you.
All right.
Thank you, Manan.
Okay, bye.
Thank you.